little brief history lesson for you to jog your memories. As just a year ago, with this meeting, we got ourselves a jumbo cut to kick off the rate cutting cycle, one that was from above 5%, maybe expected a very consistent rate cutting cycle. That's not what we got. We got a jumbo cut. We got 2 more cuts, and since then, nothing. As you know, from the start of this year, markets pricing in 6 or 7 cuts this year. As we stand here in September,
Too late.
Nothing yet.
Too late. We don't even call him Powell anymore.
Just Mr. Too Late.
Mr. Too Late.
But it might be Mr. Time is Right in September. Markets now fully pricing in a rate cut for September, and even the outside chance of a 50 basis point cut. And so I went back, did a little digging, some light digging into what happened last time. Fed delivered a 50 basis point cut, 25 basis points expected, but it was very up in the air. This 50 basis point cut was very much on the table. And the traditional expectation would be, you have some chance of a 25, you get a greater cut than expected, dollar's going to drop. Not exactly what happened, because as we have the sequence of events here around these meetings, we have the data release, then we have Mr. Fed Chair Powell come on 30 minutes later, give his commentary on their decision and what's going on in the landscape. And so what he delivered just 30 minutes after, we saw some immediate dollar selling was, don't expect more 50 basis point cuts. The actual whole rate cutting expectation for months out was actually not as dovish as people were expecting. So a bit of a mixed bag there. And then you're looking at all these other currencies. You had over one day you had 1 day dollar weakness with the exception of Swiss franc and Japanese yen. Maybe that speaking to, more of the risk sentiment at that time. But over 1 week, you had every pair dollar weaker. And then at the 1 month horizon, you had every pair bounce back, dollar complete bounce back. And as you know, into the fall and the end of the year, dollar much stronger. So
I didn't know that. That was that a thing?
So, as we've talked about year to date, what the dollar's performance is, that was coming off of, what really was highs for the dollar, lining up there with year end. And so then also checking back into what the global central bank interest rate landscape was at that time. Everyone was cutting. Everyone was kind of cutting on pace, not necessarily what you have here now. And why would we cut? Even though it was a jumbo cut, the economy was still strong, just rates were also exceptionally high. So a bit of a different, perspective. Is this what you guys remember from the jumbo cut? I know you guys weren't looking necessarily at U.S. dollars. Yeah,
this wasn't really our realm.
But not as surprising as what I would have expected from a, double the standard cutting magnitude.
Now that's with so a little bit more up in the air. The cuts were
correct. Exactly.
Right now we've got it's actually at about a 10% probability of a 50 basis point cut. So it's much more of a tail projection.
Yeah. Let's go to the next slide. We'll compare.
You're already covering this. I don't even. Okay, go on.
Sometimes I think about things. So what's different this year? For one, we're looking at FX markets, which are all in pairs. So the relative game is really what the highlight is. And right now we're not leading the easing cycle, while we have stayed as a result of economic strength. So, some would say good for our currency. Other central banks have been cutting during this time, and now at this point in time are not necessarily primed to cut. Again, like the European Central Bank meeting tomorrow is not set to cut. Their rate's already at 2%. And so price action aside, we've seen dollar weakness to a great degree. We're already down over 8% year to date against a basket of currencies. and that's despite, all these other central banks easing and us staying. So a bit more of a nuanced picture here. And like you called out last time, definitely greater expectations of that jumbo cut here, a tail risk at 10%. And as well, sentiment, looking at, what Mr. Chris Vecchio loves to cover, the traders report. We're in a categorically different environment where we're not as positioned, traders are not as positioned heavy long US dollar. So, a bit more nuanced situation. We're already in some US dollar weakness. What the cutting cycle is, who's to say? But looking at the next slide, here you have it, all the expectations around. This is looking at the CME FedWatch tool, what the current expectations are from a market standpoint. You have that 10% chance of a 50 basis point cut here. By year end, 75 basis points total expected. So that could, the most likely path would be 25 at each meeting. And long term, getting all the way down to around 3%. So what we've seen historically is, even though the cutting cycle wasn't as long as expected, once they start, they continued, at least last year, for 2 successive meetings and stopped altogether. But the name of the game will really be not as much if this is 25 or 50 in September, but where are we going in the year end over the next, 5 meetings, 10 meetings.
If they did one jumbo and then said, okay, that's it.
Correct.
You'd probably have a bid in U.S. dollar.
100%, yeah, because right now we're pricing in 75 basis points total for the end of the year. That's kind of, they're all participants at all ends of the curve here in terms of time expectations, but spot sensitivity, you are looking at this meeting, you're looking at the next few meetings for that sensitivity. And this is recent, right? Because not too long ago, I'd say a month or so ago, the expectation was really anchored around 2 cuts, and markets have been expecting the front month you're going to start cutting, but that October cut was definitely not priced in not too long ago. Just either they do September, October, September, December, but 50 basis points total. And so now, as we currently stand, 3 25 basis point cuts priced in for the rest of the year.
This has to be one of the biggest moves in the U.S. dollar in such a short period of time in terms of the basket of an 8%.
100%, yeah.
This is one of a handful of occurrences, or this is a big.
Yeah, especially across the board, speaking to the U.S. dollar side of that story specifically. And it's not all to do with central banks, as, in a calmer environment, it might be a lot to do with the current administration, global trade policy, and then kind of a snowballing effect of, what is the U.S. dollar going to retain its status as the global reserve currency? We had a Swiss banker today say, yes, that
Thank you.
they expect that to stay the case, but you got a ton of euro demand throughout the spring on some of this speculation that there won't be such a heavy dependency if the trade picture does not look as U.S. involved, as well as the U.S.'s involvement in a lot of these global conflicts as well. So while it looks on paper, rate cuts resuming historically or traditionally bad for U.S. dollar, we're positioned in a much different place here with the dollar already beat up and certain expectations already priced in. So it'll be interesting to see if CPI tomorrow changes anything and what the Fed has to say, because they don't always agree with market sentiment, as you know. So far this year, look no further as traders continually pricing in cuts that haven't been there.